So, what if I told you that you could get paid simply for owning a stock? Seriously, just imagine logging into your brokerage account and seeing cash deposits literally rolling in, month after month, quarter after quarter, all just because you happen to hold shares in a certain company. I know, it sounds like a total dream scenario, right? But here's the thing, it's not a fantasy. This is exactly how passive income through dividend investing actually works.
Welcome to today's Explainer. We're going to be unpacking a really fundamental wealth building strategy today. We're calling it the beginner's blueprint for passive income through dividend stocks. We'll break down the basic mechanics, we'll look at some of the top companies doing this, and we'll help you build a rock-solid foundation for your own investing journey.
Okay, let's dive into this. Here's our exact roadmap for the explainer. We'll start with the magic of passive income, then cover the rules of dividend investing. After that, we'll look at the Dividend Hall of Fame, how to avoid high-yield traps, the dividend ETF alternative, and finally, the secret sauce, reinvesting your dividends.
All right, kicking things off with Section 1, the magic of passive income, building wealth while you sleep.
To really wrap our heads around this magic, we first need to define what we're talking about. What is a dividend? Well, it's actually pretty simple. It's a regular cash payment from a company directly to you. They are literally rewarding you just for being a shareholder. And honestly, the absolute best part, you get these payments regardless of stock price fluctuations. Look, we all know the stock market can be a total roller coaster, right? Prices are constantly going up and down based on the news, the economy, or just general investor vibes. But a dividend? That's a tangible, real slice of a company's profits drop straight into your pocket, completely independent of whatever the stock chart is doing that day. Fun fact for you, even during the massive 2008 market crash, top dividend companies actually kept right on paying their shareholders cash. Pretty amazing, right?
Moving right along to Section 2, Rules of Dividend Investing. What actually makes a good beginner stock? So the crucial point here is that before you go out and buy any dividend stock, you need to demand these three absolutely non-negotiable qualities. First up, you want a history of paying dividends consistently. You're looking for a track record that proves this company actually prioritizes rewarding its shareholders. Number two, strong and stable earnings. Because let's be real, a company can only pay you cash if it's actually making cash, right? And third, you want a reasonable dividend yield. Now, I know it's super tempting to chase those massive, giant payouts, but as we'll see in just a bit, sustainability is way more important than a flashy number.
All right, let's get into Section 3, the Dividend Hall of Fame. We're looking at 5 cornerstone companies.
Now, what's really interesting here is how incredibly recognizable these names are. Take Coca-Cola, for example. Get this. They've actually increased their dividend payout every single year for over 60 years. Beginners absolutely love that kind of stability, which comes from their massive global brand recognition and super stable cash flow. Next up, Johnson & Johnson. They operate across pharmaceuticals, medical devices, and consumer health. Because healthcare is pretty much always in demand, no matter what the economy is doing, it offers a really defensive, safe business model. Then we've got Procter & Gamble. From your toothpaste to your laundry detergent, they make the exact things millions of us use every single day. And that means consistent profits, even during economic downturns. PepsiCo is on here too. And there aren't just soft drinks. They own a massive portfolio of popular snack brands, which gives them really diversified revenue streams. And finally, Microsoft. Now, you might think of them just as a high-growth tech stock, but their dominant software products and incredibly strong balance sheet make them a fantastic hybrid. You get growth potential plus reliable dividend income. If you look closely at those companies, a super clear theme starts to emerge. Basically, boring is beautiful. Seriously. Selling everyday essentials like soap, soft drinks, bandages, office software, it basically creates this incredibly reliable economic shield around a business. Think about it. People might put off buying a fancy new luxury car during a recession, but they absolutely aren't going to stop brushing their teeth or washing their clothes. That everyday reliability, it translates directly into the rock-solid profits a company needs to pay you your dividends year after year after year. Now for Section 4, avoiding high-yield traps. Because folks, bigger is absolutely not always better. Okay, so when you first start looking into dividend stocks, you are inevitably going to come across a number like 12%, or maybe even 15%, and your eyes are going to widen. You're going to sit there and think, wait, why on earth would I buy a company paying 3% when I can grab this one paying 12%? Watch out, because this is the classic siren song for the beginner dividend investor. Let's actually contrast these two approaches. On one hand, we have that massive but totally unsustainable 12% yield. Often, A yield gets artificially pushed that high simply because a company's stock price has completely plummeted. Maybe they have an internal crisis or just massive debt. If the company can't sustain those cash payments, that dividend could be drastically reduced or just wiped out completely. And that leaves you holding a broken stock with zero income. Not good. On the other hand, we have a lower but growing yield. Sure, it might start out at just 2 or 3%, but because that company has strong, healthy earnings, the payout is sustainable, it's consistent, and they can easily afford to bump it up over time. Without a doubt, that lower growing yield is the vastly superior long-term choice. Which brings us to Section 5, the dividend ETF alternative. This is instant diversification made incredibly easy. Look, if picking individual stocks feels a little too risky or overwhelming, an ETF, which stands for Exchange Traded Fund, is your ultimate shortcut. Instead of buying one single slice of one specific company, an ETF lets you buy a whole basket of dozens, sometimes even hundreds, of dividend-paying companies all at the exact same time. And this brilliantly illustrates how you can slice up that pie. You've got options like dividend-focused ETFs that target really high-quality yields, or dividend growth ETFs that focus entirely on companies with a history of increasing their payouts, or even broad market ETFs that just give you general, everyday exposure to all the market's dividends. By slicing up the pie like this, you instantly spread your risks safely across many different companies. It is a fantastic, totally hands-off approach if you're just starting out.
All right, the final stretch. Section 6, the secret. Reinvest your dividends. This right here is the true engine of wealth creation.
Let's move to the compounding loop and see how this all builds. You know, Albert Einstein supposedly called compound interest the eighth wonder of the world. And honestly, this is exactly why. The real absolute magic happens when you don't actually spend that cash dividend. Instead, you use it to automatically purchase additional shares of the stock that just paid you. So, step 1, because you bought more shares, your overall share count grows. Step 2, because you now own more shares, your very next dividend payment is actually larger. And step 3, you use that larger payment to buy even more shares. It's literally like a snowball rolling down a mountain, getting bigger and faster. Over years and decades, this compounding loop massively accelerates your wealth creation. It's the exact strategy that has helped countless everyday folks build incredibly substantial portfolios. So, as we wrap up this blueprint, let's just quickly cement our ultimate takeaways here. Number 1, always focus on quality, strong businesses. Remember, boring is beautiful. Number 2, look for reliable earnings and long dividend histories so you know the cash is sustainable. And most importantly, number 3, check your mindset. This is about building a steadily growing stream of income. It is definitely not a get-rich-quick scheme. Patience and quality, those are your true keys to long-term wealth. Which leaves us with just one final thought. Are you ready to start building your own stream of income, one dividend payment at a time? The blueprint is right here in your hands, and that compounding loop is just waiting to be started. But as always, remember to do your own research first to make sure this aligns with your personal financial goals. Thanks so much for joining me for this explainer, and